Most people think Visa and Mastercard are just logos on a card. You tap, you pay, you leave. Nothing feels dramatic about it. But behind that simple action is one of the quietest power struggles in modern business. A battle that moves trillions of dollars every year without ever asking for your attention. Because Visa and Mastercard are not banks. They don't lend money. They don't hold deposits. They don't chase debt. Yet they're worth more than almost every bank on earth. They built empires without touching the money they move. And the rivalry between them isn't fought in public. It's fought in boardrooms, contracts, data, fees, and systems most people never see. This isn't a story about credit cards. It's about who controls the rails money travels on. When you pay $4 for a coffee, most people assume Visa or Mastercard takes a cut, maybe 4%, maybe 2%. They don't. Almost all of that fee goes to your bank. Visa and Mastercard take a fraction, often around 0.1%, pennies. So how do companies that earn pennies per transaction make tens of billions of dollars a year? One word: volume. Visa processes around $14 trillion in payments every year. Mastercard processes close to $9 trillion. One transaction means nothing. Billions of them mean everything. Every coffee, every fuel stop, every online order, every bill. A tiny toll, charged endlessly. And here's the part most people never realize. You don't choose Visa or Mastercard. Your bank does. Banks negotiate behind closed doors. Fees, incentives, marketing budgets, data access. Sometimes Visa will pay a bank millions just to switch networks. Then Mastercard comes back with a better offer. Consumers never see it. But every bank is a battlefield. This rivalry goes back decades. Visa started as a product of Bank of America. Mastercard was created by rival banks to stop Visa from dominating the system. From the beginning, this was never about plastic cards. It was about control. The early years set the tone for everything that followed. Visa had a head start. It came from one powerful bank, moved fast, and focused on one thing: be accepted everywhere. Hotels, airlines, tourist cities, government services, online payments. Before most people trusted them, Visa pushed until its network became the default. If a merchant could only accept one card, it was usually a Visa. That kind of reach creates gravity. Merchants trust what customers already carry. Banks trust what merchants already accept. Over time, Visa stopped being a brand and became infrastructure. Mastercard couldn't win that fight head-on, so it chose a different path. Instead of chasing size, it chased speed. Mastercard leaned into technology earlier and more aggressively. Contactless payments, tokenization, advanced fraud scoring, virtual card numbers, partnerships with Fintech startups that didn't want rigid systems or slow approvals. When digital banks began launching across Europe and the US, many chose Mastercard first. Not because of the logo, but because the network was easier to build on, more flexible, more experimental. Visa became the safest option. Mastercard became the most adaptable. Both strategies worked. By the time smartphones changed how people paid, the battlefield shifted again. The fight was no longer about plastic. It was about who could power the future of money without being seen. And that's where things got far more expensive. Because the real money isn't in domestic payments, it's in crossing borders. Cross-border payments are where the quiet war turns brutal. When you use your card outside your home country, the transaction stops being simple. Different currencies, different banks, different fraud risks, different regulations. Someone has to coordinate all of that in seconds, without failure. That someone is the network. This is why international payments are gold. A coffee bought at home earns Visa or Mastercard almost nothing. That same coffee bought abroad earns several times more. Not because the networks are greedy, but because the system is harder to run. Fraud spikes, currency rates shift by the minute. Settlement can involve 3 or 4 institutions across multiple time zones. Visa and Mastercard charge more because they can, and because no one else can do it at their scale. Every travel corridor becomes a battlefield. Europe to the US, Asia to Europe, Africa to the Middle East. Each flow has its own risks, partners, and economics. Visa dominates some corridors. Mastercard dominates others. They study these routes the way airlines study flight paths. Then Fintech changed the stakes. Digital banks didn't grow slowly. They exploded. Millions of young users. High transaction frequency. International spending baked into the product. Every swipe was future volume, future data, future leverage. Mastercard moved first. Easier integrations. flexible APIs, faster onboarding. That's why so many early fintech launched with Mastercard. Not because of branding, but because speed mattered more than legacy. Visa responded with money, massive incentive deals, marketing support, lower fees. In some cases, straight-up checks are worth tens or hundreds of millions. Fintech quietly switched networks mid-growth. Users never noticed. But behind the scenes, the war intensified. And then came the data. Visa and Mastercard don't know who you are, but they know how the world spends. They see patterns before economies do, where people are cutting back, where inflation is hitting hardest, which industries are slowing, which cities are overheating. This data is anonymized, aggregated, and incredibly valuable. Hedge funds use it to predict earnings, retailers use it to plan expansion. Governments use it to understand consumer behavior. In some quarters, these insights generate margins that rival the payment business itself. So when you tap your card abroad, you're not just paying a fee, you're feeding a system that monetizes movement, behavior, and global flow. This is no longer about cards. It's about owning the pipes of international commerce. And once you control the pipes, the world has to pay the toll. For years, critics said Visa and Mastercard were too powerful, too central, too expensive. Regulators listened, lawsuits followed, governments stepped in, merchants pushed back. The biggest case ended in a multi-billion-dollar antitrust settlement, the largest of its kind. On paper, it looked like a reckoning. In reality, it barely slowed them down. Why? Because the system didn't change. Merchants still needed acceptance. Banks still needed networks. Consumers still wanted cards that worked everywhere. The rails stayed the same. Then the tech giants arrived. Apple Pay, Google Pay, Samsung Pay. Many people assumed this was the endgame. That Silicon Valley would replace the old financial giants. It didn't. Those wallets didn't remove Visa or Mastercard. They wrapped them. Every Apple Pay tap still runs on Visa or Mastercard rails. Apple controls the interface. The networks control the movement of money. Touch the screen. The old system still moves the value. The only competitor that truly worries them sits outside the West. China's UnionPay. By card count, it's the largest network on Earth, but almost all its power stays inside China, protected by regulation and borders. That's the key weakness. Payments only matter when they travel. And global travel still belongs to Visa and Mastercard. Local systems can win at home. Governments can build national rails, but the moment money needs to cross borders, the old networks step back in. And here's the part no one likes to say out loud: Visa and Mastercard don't actually want to destroy each other. Monopoly would invite regulators. A duopoly looks competitive enough to survive. They fight aggressively but within limits. Each one keeps the other alive. Two giants, permanent rivals. Perfect balance. Not because it's fair, because it's stable. And stability is everything when you control how money moves. Visa and Mastercard figured something out that most companies never do. They don't need to own customers. They don't need to approve loans. They don't need to hold money. They just need to sit in the middle. Every time money moves, they take a toll. Not enough for you to notice. Not enough to scare merchants away. Just enough to become unavoidable. Because they don't lend, they avoid credit risk. Because they don't hold deposits, they avoid banking regulation. Because they work with every bank, no single bank can replace them. It's one of the cleanest business models ever built. They are invisible infrastructure, like electricity lines, like highways. Nobody thinks about who built them until they stop working. That's why disruption hasn't killed them. Crypto didn't, fintech didn't, big tech didn't. Even governments struggle to bypass them without rebuilding the entire system from scratch. Visa and Mastercard don't win by being loved. They win by being necessary. And the more digital money becomes, the stronger they get. Cash disappears, cards multiply, phones replace wallets, subscriptions renew automatically. Each change pushes more transactions through the same rails. The war continues, but the outcome stays the same. Two companies, one global system, trillions moving quietly in the background. Next time you tap your card, pause for a second. That tiny sound isn't just a payment going through. It's a signal traveling across a global network built by companies you never see, moving money that isn't theirs, and charging a toll you'll never notice. Visa and Mastercard don't chase attention. They don't need hype. They don't need you to choose them. They already won, the moment you decided to pay. And as long as money keeps moving, their war will never end. Because the real power isn't in the cards. It's in the rails underneath it.